What if I told you that one of the world's most staggering financial empires, worth around $140 billion, was all started by a 6-year-old boy selling Cokes for a 5-cent profit? This isn't some made-up story, it's the incredible real-life journey of Warren Buffett. His climb from a quiet street in Omaha, Nebraska, to the absolute peak of the financial world wasn't a magic trick. It was built on a handful of powerful, timeless principles he started picking up as a kid. The secrets he figured out can be a blueprint for your own financial life. Warren Buffett's story didn't start on Wall Street. It started on the sidewalks of Omaha. Born in 1930, he got the business bug at a shockingly young age. At just 6 years old, he'd buy 6 packs of Coca-Cola from his grandpa's shop for 25 cents and then sell each bottle for a nickel, making a cool 5-cent profit on every pack. And the kid was relentless. He sold chewing gum and magazines door to door. By the time he was 13, he was running a paper route for the Washington Post. He took it so seriously that he filed his first tax return at 13, where he actually deducted his bike and his watch as business expenses. At 11, he bought his very first stock, 3 shares of City Service Preferred for himself and 3 for his sister Doris, at $38 a share. The stock immediately tanked. A panicked Warren held on for dear life until it crawled back up to $40. He sold, making a tiny $2 profit per share, and then he watched in horror as that same stock shot up to over $200 a share. Lesson learned: patience isn't just a virtue. In investing, it's a goldmine. By 14, he'd saved up $1,200 and used it to buy 40 acres of farmland, which he then rented out to a local farmer for a steady profit. At 17, he and a buddy bought a used pinball machine for $25 and stuck it in a barber shop. Pretty soon, they had a whole network of pinball machines making them money while they slept. Despite his hustler's ambition, Buffett's big break came disguised as a huge disappointment. After getting rejected by Harvard Business School, he discovered that his hero was teaching at Columbia. Graham was the author of The Intelligent Investor, a book that had already blown Buffett's mind, and getting to learn from the master himself changed everything. Graham taught a simple but radical idea: buy stocks for way less than they're actually worth. His whole philosophy was built on 2 brilliant principles. The first was his idea of Mr. Market, an imaginary business partner who shows up every single day, ready to buy your shares or sell you his. Some days, Mr. Market is rational. On other days, he's a total maniac, driven by wild greed or crippling fear. The key was to use Mr. Market's crazy mood swings to your advantage. The second rule was the margin of safety. Buy a business for way less than your calculation of its true value. That gap is your protection against bad luck or bad math. After Buffett graduated, he bugged Graham for a job until he finally got one. There, he learned to tear apart financial statements and think like a business owner, not a gambler. In 1956, a 25-year-old Buffett moved back to Omaha and launched his own investment partnership. He convinced some family and friends to pool together $105,000. His own contribution? A whopping $100. He set it up with a genius fee structure. He didn't take a salary. Instead, he only took a cut of the profits after his investors made at least a 6% return. His strategy was to hunt for cigar butt companies. These were forgotten, beat-up businesses that had just one last free puff of value left in them. His returns were insane. From 1956 to 1969, his partnerships averaged an annual return of nearly 30%, absolutely crushing the market. By 1962, he was a millionaire. Around this time, he found a failing textile company in Massachusetts called Berkshire Hathaway. The business was in a dead-end industry, but its stock was selling for less than the cash it had. After a fight with management, he bought so much stock that he took control of the whole company in 1965. He quickly realized the textile business was a lost cause. Instead of shutting it down, he made a game-changing move. He started using the cash the mill generated to buy other, better businesses. He bought insurance companies and discovered the magic of insurance float, the pile of premiums that you get to invest before you have to pay out any claims. With Berkshire as his mothership, Buffett started making legendary investments. With influence from his partner Charlie Munger, he evolved his strategy from cigar butts to wonderful companies at fair prices. A perfect example came in 1964 with the salad oil scandal. A big customer of American Express had been caught using barrels of seawater as collateral for loans they claimed were backed by salad oil. Wall Street went into full meltdown, but while everyone else was running for the exits, Buffett was doing his homework. He went to restaurants and banks and saw people still using their Amex cards. He realized the company's real business, its brand and customers' trust, was rock solid. He poured 40% of his fund's money into American Express and made a fortune when the stock roared back. In 1988, following the market crash, he spotted another opportunity. He started buying shares of the Coca-Cola company, eventually investing over $1 billion. To Buffett, this wasn't just a soda company. It was a fortress with an economic moat, a killer competitive advantage. Coca-Cola had the most powerful brand in the world. It became one of the most successful investments in history. What's the secret sauce? It comes down to a simple philosophy. One of Buffett's core beliefs is the power of saying no. The difference between successful people and really successful people is that really successful people say no to almost everything. This discipline keeps him inside his circle of competence. He only invests in stuff he actually understands. He sat out the entire dot-com bubble because he didn't get the businesses. Despite his incredible wealth of over $140 billion, he still lives in the same house he bought in Omaha back in 1958 for $31,500. His frugality isn't about being cheap, it's about prioritizing long-term value. His most important advice: the best investment you can make is in yourself. He's a ferocious reader, spending most of his day reading and thinking. His ultimate legacy might not be his fortune, but his jaw-dropping generosity. He has pledged to give away more than 99% of his wealth, making him one of the most generous philanthropists ever. Warren Buffett's story proves that the rules of financial success don't have to be complicated, but they demand discipline, patience, and a promise to never stop learning. If this story lit a fire for you, hit that subscribe button and ring the notification bell. Drop a comment below. What's the biggest lesson you're taking from the Oracle of Omaha? As Buffett put it, someone's sitting in the shade today because someone planted a tree a long time ago. The best time to plant your tree was 20 years ago. The second best time, it's right now.